Rezolve AI stock is currently trading live at $2.79, down roughly 8.5% in today's intraday session. And if you are staring at that red percentage and thinking this is just another volatility flush in the small-cap AI sector, you are looking at the wrong numbers. Most retail traders glancing at their screens right now see a stock sliding toward the lower end of its 52-week range and assume the momentum has broken, or that the market has lost interest in what was arguably one of the most hyped entrants into the commerce intelligence space. That is the expectation, that price action equals truth, and that a dropping ticker signals a failing business. The reality, however, is so starkly different that it creates one of the most aggressive disconnects between market sentiment and fundamental value that we have seen in this quarter. While the algorithm-driven selling pressure is pushing the price down today, the company has just executed a maneuver that fundamentally alters its financial DNA, effectively transforming it from a speculative startup into a revenue-generating heavy hitter overnight. Yet the market has not priced in a single cent of this new structural reality. We are watching a lag in information processing, where the sticker price is reacting to short-term liquidity flows while the actual asset value has arguably doubled or tripled in quality behind the scenes. To understand why this gap exists, we have to look at what just happened with the Crownpeak acquisition. This is not a small bolt-on deal where a company buys a tiny competitor to grab a few engineers. This is a massive strategic consolidation. Rezolve AI has acquired Crownpeak for $90 million, a move that immediately adds approximately $70 million in annual revenue to Rezolve's books. To put that in perspective, Rezolve's previous annual revenue was hovering around $5.3 million. You do not need a degree in quantitative finance to see the asymmetries here. They have effectively multiplied their revenue base by more than 10 times in a single signature, yet the stock is trading down today. The market expectation was that Rezolve would burn cash trying to grow organically, struggling to sign up clients one by one in a crowded market. The reality is that they just bought a massive established customer base, over 400 enterprise deployments, including blue-chip names like Tommy Hilfiger and Sephora, and they did it in a way that is expected to be immediately EBITDA-accretive. This shatters the cash burn narrative that plagues so many AI stocks. Most investors using platforms like Robinhood or engaging in online investing via SoFi Invest are seeing the headline loss per share from the last earnings report and hitting the sell button, unaware that the forward-looking earnings profile has just been completely rewritten. The tension here is palpable because the market is treating Rezolve AI like a speculative tech play that is years away from viability, whereas the company has just engineered a leapfrog event that places it squarely in the mature enterprise software category. When you look at the volume today, over 5.5 million shares traded, it suggests a battleground. The sellers are likely looking at technical resistance and the recent downward drift, while the buyers, likely institutional accumulators, are stepping in to own a piece of this new revenue stream at a discount. It's a classic case of sell the news by retail traders who do not understand the news versus buy the value by those who do. We often see this dynamic with major names. Remember how volatile Tesla stock was before the market understood its energy business? Or how Apple stock was once dismissed as just a hardware maker before the services narrative took hold. Rezolve is in that messy middle phase where the identity of the company has shifted, but the share price has not yet caught up. The acquisition of Crownpeak isn't just about adding revenue numbers, it is about the agentic commerce thesis. The expectation is that AI is just a chatbot that answers questions. The reality Rezolve is betting on is that AI will be the thing that actually does the shopping for you. By integrating their brain suite into Crownpeak's digital experience platform, they are not just serving content, they're turning passive websites into active sales agents. Let's strip away the hype and look at the mechanics of what they call brain power and the brain suite. Most e-commerce search bars are incredibly stupid. You type in "red dress for a wedding" and you get a list of everything red, including socks and t-shirts. It's a keyword matching game that hasn't changed much since the late 1990s. Rezolve's technology is built on a proprietary large language model structure that understands context and intent. It allows a consumer to interact with a store the way they would with a sales assistant. You can say, "I need an outfit for a summer garden party that matches these shoes," and the AI understands the aesthetic, the occasion, and the inventory. This is the difference between a search engine and an intelligent agent. The Crownpeak deal is the delivery mechanism for this intelligence. Instead of trying to convince 400 individual retailers to install this software, Rezolve now owns the platform that those retailers already use to manage their digital experiences. They can deploy their AI directly into the existing infrastructure of these global brands. It's a distribution coup. If you are using Schwab Intelligent Portfolios or managing your own funds through a Fidelity brokerage account, you know that distribution is often the hardest part of the software business. Building the best mousetrap doesn't matter if you can't get people to step on it. Rezolve just bought the floor where the mice live. We also need to discuss the Microsoft partnership, which is the other pillar of this bull thesis that is being ignored by today's price action. Rezolve has a strategic alliance with Microsoft that involves substantial go-to-market support. Microsoft is not in the habit of throwing its weight behind vaporware. They see the Brain Suite as a key driver for Azure consumption in the retail vertical. When a company like Microsoft agrees to co-sell your solution to their massive Rolodex of enterprise clients, it validates the technology in a way that no press release ever could. This partnership is supposed to drive over $100 million in annualized recurring revenue over the next couple of years. When you combine that organic growth target with the $70 million of inorganic revenue from Crownpeak, you start to see a path to $200 million in revenue much faster than anyone anticipated. Yet here we are, trading at $2.79. The discrepancy is startling. It forces us to ask, what is the risk that the market sees? The bear case is execution risk. Merging two companies is never easy. There is debt assumption involved in the Crownpeak deal, about $150 million worth. In a high interest rate environment, debt is a dirty word. Investors might be worrying that the interest payments will eat up the cash flow or that the integration of the two tech stacks will be clunky and slow. These are valid concerns, but they are typical operational risks, not existential ones. The broader market context is also playing a role here. We are seeing a rotation out of high-beta, speculative AI names into safer, cash-rich megacaps like NVIDIA stock or established tech giants. Small caps are being punished indiscriminately. If you are engaging in self-investing or using investing sites to screen for opportunities, you might see Rezolve's negative earnings per share and filter it out immediately. This is where the alpha lies, in the data that the screeners miss. The negative numbers are backward-looking. They reflect the costs of building the LLMs and the pre-revenue state of the business. They do not reflect the new entity that exists as of this week. It is similar to how Amazon looked terrible on a PE basis for 20 years because they were reinvesting every dollar. Rezolve is aggressively investing in land-grabbing market share in the commerce layer of the Internet. The Agentic shift is the next major phase of the Internet. We went from the desktop web, informational, to mobile, transactional, and now to Agentic, autonomous. If Rezolve can prove that their agents increase conversion rates for retailers, which early data suggests they do by significant margins, then they become indispensable. Retailers are desperate. Customer acquisition costs are through the roof. The old playbook of buying Facebook ads is getting more expensive and less effective. They need a way to convert the traffic they already have. Rezolve's thesis is that a conversation converts better than a catalog. Let's take a moment to engage with this idea. Comment below how many shares of Rezolve you currently hold, or if you are waiting for the dust to settle on this acquisition before entering. Do you think the debt they assumed for Crownpeak is a poison pill or leverage for massive growth? I want to hear your take on whether agentic commerce is the future or just a buzzword. Now, returning to the analysis, we have to look at the institutional footprint. Unlike widely held retail favorites like Robinhood stock trading or meme plays, Rezolve has a tighter float and a more complex ownership structure. The recent moves suggest they are positioning for institutional adoption. Big funds don't buy concepts, they buy cash flow and scale. By acquiring Crownpeak, Rezolve has effectively graduated into the weight class where institutional capital can start to deploy. They now